Is the old relationship between Bitcoin, gold, and stocks breaking down right in front of us? In today's video, we're digging into a major shift that's reshaping how these assets move together, and what that could mean for your portfolio in 2025 and beyond. We'll unpack the traditional correlations, show what's changing now, and give you a clear, no-hype view of how to think smarter in this new environment. Stick around, because understanding these shifts could be the key to staying ahead in a very different market landscape. Let's get right into it. Traditional correlations. What we always expected. Historically, Bitcoin was often called digital gold because of its perceived safe haven qualities during market stress. Meanwhile, gold maintained its classic role as a risk-off asset, rising when stocks fell. Stocks, especially the S&P 500, generally moved with economic optimism, inversely to gold and sometimes Bitcoin. Traders and investors built strategies around these patterns, using gold as insurance against stock volatility and viewing Bitcoin as a new age counterpart. For years, this setup gave a sense of predictability. Knowing how these assets danced around each other helped manage risk and find opportunities, until new forces started shaking things up in 2025. What changed in 2025? The new market reality. The world in 2025 looks very different, and so do asset behaviors. Artificial intelligence-driven trading algorithms now dominate volume, reacting faster and smarter than human traders. Inflation dynamics shifted with persistent high rates, while geopolitical tensions kept global markets on edge. Meanwhile, the traditional banking system's vulnerabilities became more exposed, pushing investors into alternatives. These forces combined to scramble old correlation patterns. Assets that once moved predictably against each other, like Bitcoin versus stocks, now show surprising, sometimes simultaneous, rallies or sell-offs. The new market reality demands a fresh understanding of relationships that once felt almost automatic. Bitcoin's behavior, no longer just digital gold. Bitcoin's identity has evolved fast. While it was once viewed as a digital version of gold, today it behaves more like a high beta risk asset. Instead of automatically surging during stock downturns, Bitcoin often mirrors equity market momentum, moving sharply both ways with risk-on sentiment. Institutional investors treating Bitcoin like a tech stock proxy has accelerated this shift. Liquidity cycles now heavily influence Bitcoin's moves, with artificial intelligence-driven hedge funds trading it based on macro trends rather than ideology. It's a major pivot that forces investors to rethink old assumptions about Bitcoin's role in diversified portfolios. Gold's resilience and shifting role. Despite all the change swirling around, gold has quietly reaffirmed its historical role. But with a twist, gold remains a solid hedge against systemic risk, but its price action has become more sensitive to real interest rates and monetary policy shifts. With central banks buying gold aggressively in 2025, its behavior reflects both traditional safe haven demand and strategic asset accumulation. Interestingly, while Bitcoin sometimes struggles under financial tightening, gold often thrives. Gold's resilience shows that while new assets emerge, the fundamentals of trust, scarcity, and long-term value still matter. Investors are leaning back into gold with fresh respect. Stock market volatility. The wild card factor. Stock markets in 2025 are no longer purely driven by fundamentals like earnings or growth prospects. Macro factors like government intervention, global liquidity waves, and artificial intelligence-based trading algorithms drive short-term volatility. Stocks have become more prone to violent swings, and correlations with assets like Bitcoin and gold have fractured during periods of extreme moves. When stocks dip hard, Bitcoin doesn't always rally, and gold doesn't always spike immediately. This wild card behavior adds complexity to portfolio management, forcing a re-evaluation of diversification strategies that used to rely on simple inverse correlations. The new correlation matrix. Numbers tell the story. Recent correlation data clearly shows the shift. Bitcoin's correlation with the S&P 500 in 2025 has hovered around 0.60 to 0.70, a strong positive relationship. Meanwhile, Bitcoin's correlation with gold has dropped closer to zero, sometimes even turning negative during short windows. Gold maintains its traditional slight inverse correlation with stocks, but now behaves with a longer lag. This new matrix means Bitcoin behaves much more like a tech growth asset, while gold stands more distinctly as a hedge. Understanding these real numbers, not assumptions, is critical for positioning portfolios correctly in today's environment. How traders and investors are adapting. Smart traders and investors aren't sticking with outdated playbooks. They're adapting by treating Bitcoin as part of their high-risk, high-reward allocations like growth stocks. Meanwhile, gold is increasingly positioned as a macro hedge alongside cash and bonds. Some are creating hedged portfolios that use both Bitcoin and gold in different proportions, depending on the macro outlook. Artificial intelligence portfolio management tools now analyze rolling correlations to adjust exposure dynamically. Flexibility is the name of the game. Those who adapt to the evolving relationships stand a much better chance of protecting capital and finding real growth. Risks of assuming old patterns still work. Clinging to old assumptions about how Bitcoin, gold, and stocks move together can be dangerous. 2025's market environment is fast-moving, data-driven, and heavily influenced by machine learning models. Assuming Bitcoin will save a portfolio during a stock crash could lead to painful surprises. Similarly, expecting gold to spike immediately during every dip overlooks changing investor behavior. Blindly relying on yesterday's relationships without recognizing today's dynamics risks bigger drawdowns and missed opportunities. Staying flexible, questioning assumptions, and following live data rather than old narratives is now essential for smart investing and trading. What this breakout means for 2025 and beyond. The new correlation breakout isn't just a short-term fluke, it's a sign of deeper structural changes. As artificial intelligence continues to dominate market activity and macroeconomic forces stay volatile, we should expect asset behaviors to stay fluid. Bitcoin, gold, and stocks are carving out new, more complex relationships. Investors who stay nimble, respect evolving correlations, and update their strategies regularly will have a massive edge. The days of set it and forget it portfolio models based on fixed correlations are fading. Understanding and adapting to the new landscape will be a survival skill and a wealth-building opportunity for years to come. Actionable takeaways. How to position yourself now. Right now, the smartest move is to diversify based on behavior, not assumptions. Treat Bitcoin like a growth asset with serious upside and downside volatility. Hold gold as a steady hedge against monetary instability and systemic risk. Manage stock exposure carefully, watching liquidity trends and macro shifts closely. Use tools, including artificial intelligence-driven analytics. The correlation breakout creates both danger and opportunity, depending on how quickly you adjust. Stay alert, stay strategic, and stay ahead. The game has changed. Bitcoin, gold, and stocks aren't moving like they used to, and that opens the door for both smarter strategies and bigger mistakes. Thanks for joining me here at Nexus Dividends. If you found this breakdown helpful, hit that like button. Drop a comment with your thoughts on where you see correlations going next, and make sure to subscribe for more sharp, no-hype market insights. Stay smart, stay adaptable, and I'll see you in the next one.